Hey guys, it's Ashley Brown, your trusted realtor with Long and Foster Real Estate. We're back again today with my special guest Ryan from Prosperity Home Mortgage, and today we're going to talk about ARM loans and jumbo loans. So grab your coffee, sit back, and let's go ahead and get started. Joining us again today, Ryan. How are you today?
I'm good. How about you?
I'm great. So today we're going to talk about loans again.
Okay.
So how about you explain to us what is an ARM loan?
So an ARM loan actually is an adjustable rate mortgage. What that means is the loan interest rate can go up or go down depending on the type of ARM that you're doing. Generally what an ARM loan has is where it may be fixed for a first period of 5 years, 7 years, 10 years, and then it can adjust up or down. Now with an ARM loan, which is different than a fixed loan, when you have a fixed mortgage, that monthly payment stays the same from the first to the last payment if you stayed in that loan for the full 30, 15, 20 years.
Okay.
With an ARM, it generally depends. It's tied to an index, and that index is used to determine after the fixed period is up of what your interest rate is going to be. So an ARM loan can change your payment. It can go up and it can go down. Now there are caps that it can't go above a certain amount. Basically there's a ceiling to it, and there's also a floor that it can't go below that. The one thing that happens with ARM sometimes is the payment can jump up. Now your lender does have to give you notice before the interest rate does go up, which in turn is going to affect the monthly payment. ARM loans are not a bad thing. It's bad when they're used in the wrong way. So a lot of people initially an ARM loan may have a slightly lower interest rate than a fixed product. But for instance, if you were somebody that knows you're moving around for your job, you're only going to be there for 3 years, and you do a 5-year ARM, you may end up saving yourself a little bit of money on that side because you don't have to know that you're going to be moving before that period. The only thing is sometimes long-term ARMs may not be as good of an option for you as a fixed option because there is that volatility of where the payment could go up. It could also go down. But more than often it goes up as opposed to down.
Right.
So the only thing with that is to keep in mind, if we qualify you for an ARM, we have to make sure we're qualifying you off of what it would look like if it did adjust.
Okay.
So these are also things that we have to look at. The other thing is generally we have to have a little bit of a higher credit score for the ARM product. And the other thing is a lot of times we may need to see some reserves set aside, meaning that after you basically would use the money for your down payment and closing, there's still some money set aside available, whether that's your 401k, whether it's an additional savings account, just money you have in your checking account. We may have to see that depending on the type of loan product that you're using.
Okay, so then what is the minimal credit score to qualify for an ARM?
Generally, an ARM product right now, you're gonna probably need at least a 700 credit score.
Okay, so almost perfect.
I mean, pretty much close, yeah.
Pretty close.
Yeah.
Now, the ARM loan, I haven't seen a lot of those being used, especially since COVID.
Well, even before COVID, ARMs got kind of a bad rap. It's one of those things, a fix kind of gives you peace of mind because you always know what that monthly payment is going to be for the most part, other than maybe your property taxes going up or your homeowner's insurance going up.
Exactly.
That principal and interest payment is always going to stay the same for you.
Exactly. So what would you say, what would be an ideal person to use an ARM loan?
So generally I would say an ARM could be somebody that gets transferred for their work every couple of years.
Okay.
It could be somebody that basically knows they're going to sell their house in 3 or 4 years. It could be potentially somebody that wanted to refinance and they know they're going to downsize the next couple of years and they know they're going to sell the house before it adjusts. It's one of those things, if I have a client that wants to do it, I would kind of sit down to them, explain the pros and the cons, kind of see what their timeline is, and also kind of see if they have an exit strategy set in place, just in case worst case scenario happens, that they're not going to be in a bad situation by doing that loan overall.
Awesome. Now, Ryan, let's explain, what is a jumbo loan?
Great question. So a jumbo loan is a loan that is higher than the conforming loan limits basically set in each area. So each county has a different loan limit that is set by the government basically. These loan limits can change each year. What a jumbo loan is basically it's a loan that's generally going to be a higher purchase price and a higher amount. And what this is going to do, it's going to give the person to be able to buy a house that could be 1.5 million, 2.5 million, whatever. There are different requirements for the jumbo loans. They're a little more strict on the credit scores. The other thing is generally the down payment's going to have to probably be at least a minimum 5%.
Okay.
And then the other factor is they may get a better interest rate if they do 10%, if they do 20%. There's a lot of different factors that go into the jumbo and to pricing that loan. The other factor about the jumbo loan is that generally sometimes we will have to see that you have reserves available to be able to use that to qualify. So, because a lot of times they see this is a more riskier loan because it's a higher loan amount and a higher purchase price. They may want to see that you have 6 months of reserves in case you lost your job, you got sick, that you have money set aside to make those payments.
Right. So what would be the minimal credit score for a jumbo loan?
A 680 is minimal, but I would say optimal is probably 720 or higher to be able to get a really good interest rate.
Interesting. Now, would you say a jumbo loan and like an ARM loan, they would be really great for investors?
Not necessarily, because for an investor, the only thing I would say is if you're an investor, generally if you're going to be renting the place out, you want to make sure that that monthly payment's staying the same so it's not affecting your incoming income based off of it being a rental.
Yep.
So it just kind of depends what they're looking at. But the main thing with the jumbo loan is the underwriting is going to be a little bit tighter than it would be on a conventional and FHA or VA, just because it's a higher amount generally. So that's the only thing. A lot of times too, they may not allow a jumbo loan if you've had a bankruptcy in the last 7 years, had a foreclosure, a repossession. They kind of look at things a little bit different.
Detailed in there.
Exactly.
Okay.
Yeah.
So then, what would you say is the main difference between an adjustable rate mortgage and the jumbo loan?
So the adjustable rate could be basically on any loan type, really. It's just that it's not fixed.
Okay.
The jumbo loan is basically anything that's going to be over the conforming loan limits, which then in turn is basically going to be considered a jumbo loan because it's a higher price loan. So that's why they call it jumbo, because it's generally over that. And each county is different. We can give you that information too here on a slide to show you what it is of where a conforming and a non-conforming loan are versus basically where it goes then to be considered a jumbo. That way you can kind of see, like for instance, certain areas you're looking at, each county is a little bit different of where it starts as a jumbo and where it doesn't start as a jumbo. So just things to kind of keep in mind maybe too, if you're looking with Ashley and you're looking at a certain price point, some counties you may not have to get a jumbo loan for a very high purchase price, but other counties you may have to. So it's one of those things that kind of help fine tune your search. If you're looking for, a larger, more expensive property, it may be more advantageous to go in one county than the other, for different loan programs that are out there maybe available.
Awesome, and that's why it's good because you're licensed nationwide.
Yes.
Now, Ryan, let's go ahead and go over again any special promotions and things that you have going on.
So right now we have a credit with Cinch Home Warranty. If you're a first-time home buyer making below a certain amount of money, we would basically give you a free home warranty on that product for the first year. The other thing we have is our First Responders program, where we will give a credit of $14.99 towards your closing costs for anybody that is a teacher, a firefighter, an EMT, a police officer, or nurse. So these are things that we do to try to help give back to those that give back to our community in order to basically help them offset some of the closing costs.
Incredible. Some really great information from Ryan today and the past couple of weeks. Thanks so much again, Ryan, for being
My
here.
pleasure. Thanks for having me.
I hope some of y'all found this information helpful, even inspiring. So make sure to join us next week as I'm going to have another special guest here from RGS Title, where we're going to dig in deeper to the title side of real estate. You don't want to miss out on some of this important information. Make sure to like, subscribe, follow, and share. Now remember, if you're looking to make the most of this incredible market, make sure you reach out to me, Ashley Brown, your trusted realtor with Long and Foster, and Ryan from Prosperity Home Mortgage. We're here both to help you, guide you every step of the way, ensure a smooth and successful experience. So until next time, guys, stay positive and keep those dreams alive. Bye for now.